Pretty pumped up, some amazing guests. For those that don't follow the sports industry, $50 billion was spent last year alone by institutional investors. A huge number. It was only last month, the top 50 sports franchises in the world, their value increased to over $250 million US. That's a 30% increase in the last 12 months alone. This is the go-go years, people. It's almost back to 2020. We have some amazing guests. I'm going to start with you, Gerry. Of course, sport is at the epicenter of entertainment, media, technology, consumer. It's far more sophisticated than probably what many people in the audience think around the plaything of billionaires. And I've heard you describe the Redbird approach as one of a strategic partner, someone who fills the gap between the soaring valuations and the infrastructure and the people who support it. So I'd love to dig into the Redbird approach and maybe using some of the investee companies as an example that illustrate this.
Sure. So, well, it's a big question. I'd say the 20-some years that I've been doing this, I joke, but really it's been arbitraging incompetence and inefficiency. Nobody really, this phenomenon of sports as an asset class should be a wake-up call for everybody, because when you start talking about sports as an asset class, particularly for all the public market investors out there, it might be, you might wake up and say, well, maybe that's a bubble. Maybe we should temper the irrational exuberance. What we try to do is not get enamored with the emotional part of it. We look at these as great live event entertainment companies. We've done that for 20 years, and we really try to run these as businesses. And the arbitrage that we see, and we continue to see it, is that most of these things are valued as a multiple of revenue. And we don't really buy into that. We think there's no excuse for it not to be valued on a multiple of cash flow. But one of the things that you referenced is that I've seen this unbelievable divergence. You've had this massive escalation in these asset valuations, and none of the people or the infrastructure has kept pace. And so what we do is we go into that gap and we close it. We close it with scalable capital, and we close it with operational expertise. In our firm, we commingle operators with investors. And the model really has been the same for 20 years, where we partner with rights holders, teams and leagues, and we build terminal value businesses in partnership with those rights holders. It's a great convertible bond, because the rights holders contribute the rights on a very long-term basis, giving you embedded downside protection, contractual revenues. And our job is to take $1 of contractual revenue and translate it into a reasonable $1 of cash flow. And it's a win for the teams and the leagues, because they can't do it themselves. They don't have that expertise. In the old days, owning a sports team was really a hobby for rich people. And today, it's really big business. And when these things are going for the valuations that they're going at, you got to take it a little more seriously. And we're going to be catalytic capital. We're going to be transformative and go in and help these rights holders and cross leagues and teams really professionalize these as businesses with an eye towards cash flow. And that's great for the whole ecosystem.
And the follow-up question is, if you imagine the teams and the leagues at the hub, and the spokes are the IP and the infrastructure around that, historically you've invested in the latter, but you've moved from rights holder to rights owner. What's been the thinking behind the shift?
Yeah, look, the big break in my career was 20-something years ago when George Steinbrenner, who was the owner of the New York Yankees, approached us, and he had broken away from another family business owner, which was on the distribution side, the Dolan family that owned Cablevision and MSG. And basically what George was saying was, why am I getting paid a fee when I'm the guy that's taking the risk and I'm putting the capital in to put, these players on the field to provide the entertainment content? I should be getting the terminal value appreciation, not Cablevision. And that was the seminal moment for me. And so, we partnered with the Yankees and created what became today is the #1 regional sports network in America. That model of partnering with the rights holder and creating, a multi-billion-dollar business, we did that up until, we're still doing it, but then 5 years ago, it started to dawn on us that there are only so many George Steinbrenners. There's only so many Jerry Jones from the Dallas Cowboys. We partnered with that family and put them together with the Yankees to go create something called Legends Hospitality. There's only so many of them, and we said to ourselves, well, why don't we vertically integrate and become the rights holder ourselves? And so that's what we've started to do. The great place to do that has been European football. In America, there are ownership restrictions that really don't allow our kind of capital to come in. In Europe, there are no ownership restrictions. The flip side of that coin, however, is there's something called the transfer market and relegation, and that's attracted sovereign states and oligarchs, which has scared me off for many years. But then we created a partnership with a guy named Billy Beane, who you may know from the Moneyball movie. And Billy actually, I give him full credit, Billy was the one who really taught me and explained to me that actually European football is Moneyball. The right way to play a transfer market relegation ecosystem is to think about it the way Billy thinks about it in America in terms of Moneyball. You know, you buy low and you sell high and you focus on cash flow. It's a data analytics driven approach, and that's what we've done.
Kara, I'm going to bring you in here. For those that don't know, Angel City is the hottest ticket in town when it comes to Hollywood, and it's only 1 year old. It's an incredible story, and you are, of course, the co-founder. Sohn is known for its stock pitches. There have been some fantastic ones already today. If I asked you to give the 3-minute pitch for Angel City, what would you do?
Well, Ed, I think you might have a video that can do some of the work for me, so maybe we could start with that?
Cue it.
Yes, beautiful people. Do you know what's better than putting on for your city? Is your city putting on for you? Yeah, the city putting on for you. Yeah, see the real, recognize the truth. And now you, and now I'm running with the
LA's new soccer team, founded by some of the most famous women in sports and entertainment.
It was founded by actress Natalie Portman, and it is backed by a star-studded group of women investors, creating the largest female lead ownership group in professional sports.
Hey, welcome to LA. You know we don't play. Go hard every day. And we up so high, I can't even see the ground. Feeling like can't nobody stop me now. Never mind, Icarus, I'm finna take it further than he ever did. Woman, another synonym for victorious. Yeah, pressure builds diamonds, we out here shining. We keep walking through adversity. We busting through your glass ceilings, what a wonderful feeling. Making history and it will repeat. Ha.
The poor fundies get PowerPoint, you get the power of Hollywood hype reels. That's not fair.
So listen, it's such an exciting time to be here. You guys act for so many reasons, but you have the Women's World Cup coming to Australia, and an amazing team in the Matildas this summer. For me, the story of Angel City began in 2015 when I went just as a fan to the World Cup finals in Vancouver with my husband, my 3 daughters, and my parents. And I had been a sports fan my whole life, played somewhat mediocrely, and I felt like I belonged. And then I couldn't find content, I couldn't find merchandise, and I thought, am I the only one in the world that people don't want to take money from me? I want to give you my money. Why won't anyone take my money? And so the analogy I make now is it's as if you had a 2-hour, 90-minute Super Bowl commercial, and then the website is down for 4 years. The virtuous cycle of understanding demand creation was just something that most people were very skeptical about. And so, you know, some of the people who are now investors and on our board said to me, Kara, that it's just never going to work because you're never going to get a broadcast deal. And the way you make money in sport is broadcast. But there was one leading indicator for me that I used when I spoke to hundreds of investors. Unfortunately, I got one to say yes about 3 weeks before COVID. And sometimes I think if it was 3 weeks after COVID, I would be at the conference in 2028, not today. And it was Instagram. And on Instagram, I could follow players. I could see other people following players. And so that's, you know, the quick version of the story. But for me, it was I'm a venture capitalist. I've operated in big tech companies, and never in a million years did I think I would be an owner of a sports franchise that's changed my life and has caused me now to dedicate 100% of my time to this. So when something is authentically there for you and have the skill around it, I think it's important to know when to have discipline. And what Gerry said is so true, because you have to have discipline in this asset class. And I think it's equally important to know when you're just having fun and you're dreaming, and when you bring those two things together.
I'm going to pick up on that because you do wear 2 hats: institutional investor, passionate co-founder.
Yes.
How do you reconcile those two? Because we've heard the importance of taking emotion out of the investment decision, And yet we also know the power of highly emotional founders and what that can bring to the brand.
Yeah, has anyone ever seen the Jack Nicholson movie Chinatown? Mother, sister, it's kind of, okay, maybe not, it's a good movie. I think it's a blessing, and sometimes it's uncomfortable because sometimes I'm sitting around the table as a co-founder and I feel like I want to be an investor, and there's a psychological relationship and a co-founder relationship that's different. But I think it actually, in many ways, gives me real perspective as an investor. I think somewhat differently with Angel City than I think now that I'm looking at other sports assets around the world, but I can appreciate that founder mentality. And I think the thing about these businesses, you know, Gerry and I were talking about this beforehand. You have to be right brain and left brain. I think these are our cultural institutions. These are the only places in the United States where we've had an eventful week. Democracy won. It was good. But it's the only place where you probably sit next to somebody from a different political party and could have a conversation with them and realize you like each other and that you're both just human beings in socially acceptable tribalism. And so I think being able to talk to different stakeholders, understand them, really approaching these teams as local community institutions, our Vaticans, you know, of the modern era, while also bringing discipline in, are really important. The short term, the long term, the heart, you know, and the numbers. They all have to kind of cohabitate here in a way that's, I think, different than public equities and other instruments and asset classes.
I agree. Matt, I'm going to bring you in here. Recently, you led a bid to buy the Super Netball in Australia. Unfortunately for you, it fell over. What did you learn from that experience? What was the friction to getting the deal done? I'm keen for you to bring the local lens to this panel.
Yeah, it was really interesting. I've obviously got a very different background, obviously playing cricket, as you know. Didn't get to the baggy green as you did, but played underage for Australia and Victoria, and then moved into technology and spent the better part of the last 15 years as a founder and entrepreneur, and more recently into venture capital, but always had sport in my blood. So it was interesting. We just on the first close of Real VC, our venture capital fund, and I was sitting on the beach in Fiji, and I was reading about how bad netball was being financially run, and I thought, there's got to be a better way. And I wrote a 3-page pitch deck and sent it to 2 investors, and they both called me in an hour and said, we'll fund it. So it was a really quick process in both ways, because they didn't open the doors, so it shut down pretty quickly. So I think one of the interesting things was sport has moved so fast internationally, and I've obviously, you know, such much experience on the panel, but in Australia it hasn't moved from an administration point of view, and probably administration is a good description of how it's run sometimes, is like it's not professionalised. And we came in with a bid that was an open-ended bid, and actually we had a $100 billion fund behind us, and we said if it's worth 60 million, then we'll pay 60 million. We put 6.5 on the table to start with, but open the books and let's have a look at it. But the board and the management decided that they didn't want to entertain the decision, and we thought it was better for the sport. We were offering a whole lot of revenue streams back into the game, grassroots, the national sport, but we thought privatising the Super Netball League would take it to the next level, and being the #1 female sport in the country, I'm very passionate about. Mum grew up playing netball for 38 years, so that was how I got involved.
Do you think how the evolution of sport in Australia, federated model, you know, a lot of the governance is outdated? You touched on the quality of the administrator, and they are sports administrators. They're in many cases, not executives. Do you think that is causing friction to private capital coming into the market in Australia?
Oh, I think definitely. I think if you look, you know, with a cricket background, having gone through the netball process, my sister's a semi-professional hockey player, and you go through and you look at who people like yourselves, Gerry, that run teams and own teams, versus some of the boards and federated structures. And I talk a lot about the bottom-up strategy, where the actual states own the national body, effectively, because the state representatives vote on national issues. Where, you know, if you look at AFL, it's a great example, where it's a top-down model, where the AFL goes out and says, you know what, we've got an amazing entertainment brand, sport, we're going to do a big broadcast deal, we've got great sponsors, we've got great fans, we've got great membership bases, and we're going to then distribute to the clubs. I think there's a way better model from a top-down model than bottom-up.
That's interesting insight. Let's zoom out for a second, because I do want the audience to get a sense of what's driving value for these teams and leagues and franchises around the world. And there are some key value drivers. I'm keen to talk about the trends and the growth, because that's generally the direction they're going. And the big one, as you touched on, Kara, is media. And there's a huge changing nature of not just how we're consuming media, but media in sport is changing. We're seeing it live time through the unbundling of cable, more over the top, large tech companies making bids for sports rights. Gerry, I'm going to start with you. Can you unpack the media landscape for us briefly, how it's changing, and I guess how the value exchange between the rights holder and the rights owner is changing?
You know, again, I come at this from a 20-plus year transom, and you know, media was always the silver bullet that bailed everybody out, right? And I think you noted this, that it's much more complicated today, and you can't rely on it. You know, technology is disintermediating the consumption of content, but what I have found is that content is the best must-carry content in a local area, and where we traffic, you know, we've been very fortunate. We traffic in local content that actually is regional, national, and global, right? You know, partnering with groups like the New York Yankees and you know, and then individuals now with the sort of the digitization of intellectual property has even extended itself now to individuals. So we're partnered with LeBron James, we're partnered with Dwayne Johnson, and we're looking to create terminal value businesses even down through to the individual. I'll give you guys a metric. Last year, so I'll say we started the Yes Network in 2001. We signed that deal the day before 9/11. By the end of the week, we backstopped the largest private equity check that had been written at the time, a $335 million equity check, and all we had was a piece of paper that said you now own 40% of the intellectual property of the New York Yankees, and we had to be on the air in April. So that was the formative moment, and it taught us a lot. We did it. First year, that other family I talked about on the distribution side that the Steinbrenner family pulled away from, didn't like the fact that they pulled away from them and kept them off the air. So we only launched in April of 2002 with 5/8 of our subscriber base. Even with that, we had $50 million of free cash flow. We won a seminal arbitration case, and within another year, we had all of the subscribers in the 9 million tri-state area of New York, New Jersey, and Connecticut, and that $50 million of cash flow went to $150 million. Mark that to market to today, and that's $450 million of free cash flow, anchored by a 42-year media rights agreement at a 6% escalator. Now, when I retired from Goldman, I sold that to Murdoch for $4 billion. We bought it back as Redbird in 2019 for $3.5 billion. I sold it at a 13 times cash flow multiple. I bought it back for an 8 times cash flow multiple. I started it as a growth equity business. I bought it back as an infrastructure play. But what we knew, going to your question, we knew what we had with that. And we also, the reason why you were able to buy it the way we bought it is that everybody was proclaiming that the cable bundle was dead. Cable bundle is never going to be dead. That is the one pipe into the home that provides high-speed internet, but it is also the one-stop shop place where you can get bundled sports. But what the bet we made, and it's proving out, was not only that the cable bundle wasn't going to die, but we also made a bet that the proliferation of direct-to-consumer and the fragmentation that you're seeing with all these streaming services, that really is only for a certain slice and segment of the population, the rabid fan base that wants to, you know, have multiple services to get more of that content and is willing to pay a premium to get it. But the middle of the bell curve is really going to be in the linear cable bundle. And so what have we done? Well, we've launched a direct-to-consumer product in the New York area, side by side the linear cable bundle. We're doing the same thing with the Red Sox in Boston. And so, you know, what you're starting to see now is last year, I'll give you the statistic. Last year, the Yes Network, this Yankee channel that we started, there were 7.7 billion minutes of that content consumed. Now, what's amazing about that is more than the top 20 primetime shows on television combined.
It's amazing how live sport is the last bastion of appointment TV, really. Anyone can watch anything on demand except live sport, and we're seeing it through the value of the rights. But for the deal junkies in the room buying an asset back at half the price to which you sold it, the people are getting twitchy up the back.
Well, I mean, it was contrarian, but when we started it, it was just us and the Yankees back in 2001. When we bought it back, we put Amazon at the table. We put Sinclair at the table. Yankees are still the largest owner in it. And so, we were sort of, it was the same, it was the same contrarian play that 20 years later that we did back in 2000, before everybody started talking about, sports as an asset class. So, I'll tell you, one of the best things about investing in sports is to have continuity. I don't think there's no way we could do what we do if we just showed up with a pot of money. And one of the things that I want to temper all the irrational exuberance that I see in the marketplace to really enhance the ecosystem is be careful about that. This is a very closed ecosystem. It's an ecosystem where nobody really ever talks about anything below the revenue line. And they're not run like professional businesses. Most people involved in sports are sponsorship people. Nothing wrong with sponsorship people or advertising people and everything else. But these are now businesses. These are mini Disneys. And with that has to come a transformation and a professionalization. We just got lucky because we've been doing this for 20 years. And now we're in a position where it's like, we're watching this perfect storm. And, part of our responsibility is not only to have our capital be transformative and catalytic to enhance our partners and the ecosystem, but also to say to everyone else that's jumping in who wants exposure to sports in their portfolio construction to maybe, think about, how best to do that as opposed to just buying stuff.
You called these teams like a mini Disney, and no one has monetized the fan or the consumer like Disney have. Kara, I'm going to talk to you about the changing nature of fan engagement, the customer or consumer proposition, and how you're thinking about monetizing it, because I can't think of an example of a first-year team packing out stadiums. I think I've heard you say that over $13 million of sponsorship in year one. You must be doing something in Stadia to create an experience that people want to come back for and allow you to very smartly monetize them.
Yeah, so Ed, I'm going to answer, but I feel like the stock I should pitch here is women's sports, truly, and I think Angel City is emblematic of it, but, and it's not all women's sports. You have to be thoughtful about the size of your domestic market, kind of global trends, things of this nature, but in some ways it's a huge blessing at Angel City that we didn't have traditional revenue streams. We didn't have a Nike, Adidas, or a big broadcast deal that was driving revenue through. We didn't have the $11 billion NFL contract. And so when we went out, we said, okay, how do we go from zero to big? And we don't quote our revenue numbers publicly, but we have more revenue than a third to a half of the men's football teams in the United States, many of whom are now trading for $500 million to $1 billion. And we've grown our valuation probably 30 to 40x in the 2.5 years since we started it. And so there is a massive arbitrage on sexism, I'll say that. And you bring in great operators and humility with that great operating. The three of us didn't, me and my two co-founders, one of whom, yes, was the female Thor. And when she says, hey, Kara, why don't we start a soccer team, which is what we call football in the U.S., you kind of have to say, even when on the third time you say, okay, maybe I'll go check it out. But my third co-founder came out of tech and media and didn't come out of sports. And we've surrounded ourselves with people in sports, in real estate, and we've learned quickly. But in a lot of ways, I think it is, necessity is the mother of invention, of innovation. And we will get those revenue streams. And then honestly, I tell people we started Angel City for 3 reasons. One, and this is important for sustainability of business models, to show that we can pay players, but sustainably, right? If you look at our salary cap, it's less than $2 million. Our revenue is many, many, many multiples of that in the first year. We're never going to have an EPL problem, and our players should get paid a lot more. But these are actually businesses that can cash flow, especially as broadcast revenue comes in. And so I will answer your question, but in the first year, it's been ticketing revenue and sponsorship revenue. We've contracted north of $40 million in sponsorship revenue. We've brought in sponsors that have never advertised in sports before. Women drive 85% of the $7 trillion of consumer spend in the United States. So we have shoes and supplements and women's alcohol, along with Gatorade and Nike and the like, and we donate 10% of every sponsor contract. We put it into a community cause. So DoorDash, who is our Jersey sponsor, I think we'll deliver 400,000 free meals to food insecure parts of LA. So anyway, only to say, I'm here to talk to you guys about the stock pick, about women's sports in your country, because you can get venture-like returns, but actually with growth equity-like risk if you pick carefully, and most of the world is still waking up to this, so there is a window in time in your local community for the next 3 years. It starts with community. Natalie, Julie, and I walked through a game at LAFC and saw somebody waving a flag saying, "Bring women's football to LA." And those were our first 2 community members, the Rojases. We now have 7 groups. We manage them like, they are our fourth estate, and they give us feedback when we do things that they don't like. There's a lot of accountability. There's a lot of purpose. Authenticity in women's sport is incredibly important. We're held to a higher standard in that regard. And so now we have a full section that's just our supporters groups, drum circles, Slack channels. I ride an e-bike around before games, and I go hang out with them and eat tacos and throw the tequila over my shoulder. And I think, Ed, you're going to start our 8th supporter group here.
I can today,
on stage,
actually.
yeah?
I've been live on the merch store. Not the first striptease of the day, I'm told, but I bought myself some Angel City merch.
Amazing.
Tank top, I won't do the
Amazing.
rest.
I welcome all of you to come to a game. We'd love to host you.
Matt, one of the great value drivers for sport is obviously IP. And historically, the power of this, and we'll touch on this, has been with the league owners or the franchise owner, but it's now much about the player. What's the new wave of IP? Where's this going, whether it be Web3, gaming? I know you're involved in a fascinating company called Livewire. How are teams thinking about monetizing IP?
Yeah, it's super interesting. Livewire was our first investment in our venture fund, so it's a gaming tech company based in Australia, but in 6 countries already. And we've just started Livewire Sports, actually, in the last month, and we led the seed round. And one of the fascinating things over the last 10 to 12 years, a lot of people in Australia would know, that the change from newspaper to classifieds to obviously online classifieds, and I was lucky enough to have a front row seat with, Matt Berriman from Seek and Greg Roebuck from Car Sales, and also Lachlan Murdoch were investors in my first technology company. And the one slide just got me, and it was 8% of time on linear TV, $55 billion of spend, 37% of media time, eyeballs, on gaming, $1 billion worth of spend. And history tells you that the money will always follow the eyeballs. So we've got an exclusive deal with Roblox, and now we're talking to sports teams and leagues so that people can pause their Roblox game and watch the game live. So just like 10 years ago when people were doing rights deals, it was TV only, and then it became TV and digital, and then it became TV, digital, and mobile. We think gaming will become part of the ecosystem of rights sponsorship in the future.
There's a crazy statistic. I think there was 4 billion hours of FIFA, which is the soccer game for those that are uninitiated, played last year, and 2 billion of hours of watching people play FIFA. There is certainly a dynamic that is changing in the world that probably slips our generation by. But Gerry, you've been at the heart of a lot of these IP deals, and there's been a shift, as I said, from the team owner to the player. The player is a brand of themselves these days. How are players thinking about monetizing their own IP, and how are investors like yourself thinking about monetizing them?
Well, we stumble. There's the player individually, and there's the collective players. So the starting point, you have to look at that. This NFT phenomenon and the individualization of intellectual property monetization really is so far is really only for a certain select group. The Dwayne Johnsons, the LeBron James. Tom Brady hasn't really been able to do it, and there are reasons for that. But what we were fascinated by was the collective players. And, we were approached by the player unions of the NFL and Major League Baseball. And they came to us, and it was interesting. They came to us because they wanted to start a venture fund. And I thought that was odd. And I said, why do you want to start a venture fund? And they said that they're looking at all the Silicon Valley, they're looking at the Golden State Warriors in California, who all are getting Series B and C allocations in all these companies. And they like, we want that for our players. And I said, well, I'm slow down a minute. I said, come in, let's whiteboard. Let's figure out what you're really asking. Let's figure out what the right thing to do is. And we spent a bunch of time with them thinking through all of this. And our conclusion was that actually, you guys as the union, you are the venture fund. And so what we ended up doing is we took their collective licensing rights, really for the Madden football video game on the NFL side and the Sony baseball game on the Major League Baseball side, and we corporatized it. We bought those rights to those games in perpetuity, capitalized it at a 7.5 times cash flow multiple. At the time, it was $40 million of cash flow, so $300 million valuation, and we created a company called One Team. We monetized our stake. We sold our stake just under 2 years later for a $2 billion valuation. We had grown that 40 million to close to 200. And how did we do that? Well, when we did this deal, really getting to your point, I can't tell you the outrage that I received from the other parts of the value chain. The leagues and the teams, the ownership called me and they said, "What are you doing?" And I go, what do you mean? They said, you've worked with us for all these years and now you're partnering with the enemy. I was like, who's the enemy? And they're like, the players. I said, whoa, hold on. I said, you can't have a game without the players. They're your partner. I said, so what was fascinating, and I thought I knew sports, but what was fascinating is if you look at the value chain in sports, all the money went to, it's very simple. It's players, leagues, and teams. And all the money went to this 2/3 of the value chain, and none of the money ever came to 1/3 of the value chain. Now, that's not sustainable. That's anti-Darwinian. That's bad, right? And so what we did is we came in and we sort of leveled the playing field a bit. And I said to the NFL, I said, look, we'll even show you. So I said, let's partner you, the league, with you, the union, and let's go together with us in the middle to Electronic Arts, and let's go renegotiate that deal. And that's what we did. And sure enough, what happened? Yes, we increased the pie, but what we also did is we moved it from the vendor partner to the content owners. And that was just an eye-opener for me. I had not seen that before, and that is something that we want to perpetuate. There is a huge opportunity, to your point on players, and with what you're doing, it is a huge opportunity to bring this kind of capital, this kind of professionalization, this kind of company building to collective players as well as to individual players.
Totally agree with that, and I know there are a lot of active players even in the Australian market who are thinking the same. Ripping up sponsorships left, right and centre. This timer in front of me is moving way too quickly, so I'll move along to a topic close to everyone's heart in this room, and that is valuation. Macro headwinds by every indicator, and yet every time I look at a new sports valuation, it's finger in the air, last transaction plus 30%. Huge opacity when it comes to the valuation of these teams, and you touched on it, Karen, in 2 years, how much of a valuation uplift you've seen. How are we to think about valuations in the sports market? Is there a bubble, or you think it's only moving in one direction?
Well, it's an interesting market to be in. I spent the last 25 years in tech and have just moved over to sports. And it reminds me, I was 23 years old when I started in venture capital in 99. And it was this little industry, and I would cold call people, like I'd circle names of tech companies in Boston and literally use a phone and call them, and they'd never heard from a venture capitalist before. And sports sort of feels that way now, even though it's in the press. It's so often in that it's a very illiquid marketplace, and it's becoming liquid, and so you have these big funds coming in, and so look, like I think to answer your question more specifically, you're always going to have somebody's boyhood or girlhood team that they may pay crazy amounts of money for, but I actually think that the world is sort of waking up to the fact that, one, these are scarce assets, right? Gerry was talking about European football. You take the Premier League, you have 20 teams there in the world, the global sport. And so to some extent, there's characteristics. We are the only license to operate a team in the league we're in Los Angeles, is one of the biggest markets in the world. So they're like real estate or gold. And then many of these businesses are being run, particularly around the world, by people who just grew up in the sport, but they haven't been professionalized. They're not ready for investment. And so to answer your question, I think ultimately in every industry, you have to drive value. And it's just a question of, and so creating sustainability around cash flow, either every EPL team will be owned by a sovereign wealth fund someday that will just pour gobs of money in, or they'll start, again, getting to a place where fair play rules work, and there's more liquidity, more buyers and sellers, more interest, and they'll sort of normalize and rationalize. But I think you see certain sports that are, netball I've learned a lot about. I'm very excited to try to play it. I played basketball, so I'm told I can't dribble.
You should put a
But if you look at sports like, football, racing, tennis, other sports that are global in nature, where the total addressable market is 7 billion, then we have a long way to go. If you look at an entertainment industry, which I think is, multiple trillions of dollars in the United States alone, it's not just broadcast revenue, it's all the rights we're talking about. And then if you look at how, one of the things I'm super passionate about is bringing in women, people of color, underrepresented folks out of tech and media into sports teams and leagues. I mean, that's what I'm doing now around with investment behind it, and diversity of thinking in these industries and execution. I think you'll see greater and greater efficiency, like what you see when you look at a Nike or something like that. So I just went to the MLS Cup finals. You guys have maybe never heard of it. It's the soccer league in the United States, 10th or 15th best in the world. It was an incredible entertainment experience. It wasn't the best soccer in the world, but it was one of the most entertaining games I've ever been to in the world. And so when you look at a domestic market in a sport like that, will these teams grow into those valuations? Maybe over 10 or 20 years. So you have to be really long-term holders and really look at fundamentals, I think, over the long run, and they're there.
I think it's a great call out about the long-termism. And we're seeing some interesting structures pop up, Matt. A deal recently between Silver Lake and the All Blacks, structuring with a commercial co and the IP attached to that. Can you give some color to these kind of structures that are popping up and why investors might be doing these types of deals?
Yeah, I think that was a really interesting deal, and one that we talked about with netball about centralising the commercial assets into one unit. And I think one of the things that some sports are great at commercialising their assets, and some sports aren't so great at commercialising their assets. And bringing some experience and ability to do that in a centralised position from all the way from national to grassroots, and vertically integrate sponsorships and rights and deals through that has been successful for the All Blacks, and I think is definitely a different way to look at how sports operate. And I know there's obviously funds out there that buy into sporting teams and leagues on pretty much a structured debt structure, and they look at IRR and they don't look at massive valuation increases. So there are different models that can be based on buying.
Yeah, and one more thing I was just going to say, because I think people like data here. If you look at just, for example, the Premier League, you have teams like Manchester United who are doing $300 million in commercial revenue. You have the teams at the bottom of the table who are probably doing 10. Right, so you look at that disparity and you say, well, Manchester United is a global brand, but there's probably a lot of execution in between here and here as you bring operators in, and as these become the most coveted rights and in-person experiences we have.
Yeah, Gerry, as the person that's travelled the farthest, you get the end note.
Yeah, look.
What any views on this?
Yeah, I got a lot of views on it. Look, I think. I'll be so bold to say that, yeah, there is a bubble. We're in the middle of it, but it's not lethal, right? And that's what's interesting about it. So I think, it's very hard, and this is not just unique to sports, but I think it's very hard to buy well and have your returns trajectory set up from the buy. I think what you got to do is you got to figure out how to own better. Now, the thing about sports is the reason why there's a bubble is because people have discovered it. And I said in the opening, and the first thing I said here is that, whenever anybody starts talking about something like sports as an asset class, buyer beware. But again, it's not lethal. I think, there's scarcity value. Yes, people like the fact that it's non-correlated. People like the fact that, it benchmarked against an index like the S&P, it's very positively positioned. But, I look at that and I say that, you got to be careful. It's that old Buffett aphorism that, when the tide is high, it's great. And then when the tide pulls back, you see who's wearing a bathing suit, right? And so this concept that this thing is always going to keep going up is a problem. Now, people want exposure to this non-cyclical, non-correlated asset class that has contractual revenue anchored by media and that has the potential for further revenue streams in gaming and gambling and digitization. They want that, and they're right to want that. The question is, how do you get that? And I'd say to you that when you look at the auctions that have gone on for these teams most recently, I look at them and say, you know, they actually were not that robust. And you're right, it is like LIFO. I mean, it's you know, the equity research in sports, the irony is the equity research in sports is Forbes magazine. That's the level of rigor that goes on in sports, and it is what you said. It's you look at the last trade and you mark it up. Now I look at that and I start to salivate because I say there's a great arbitrage opportunity. If guys like us can get in there, and you know what we're passionate about is owning better, there's a great opportunity. Yes, we'll try to buy well. I think we bought AC Milan, you know, at a fair price, but well, certainly relative to what other trades that you've seen. But what we're really focused on is not that. What we're focused on is, can we own it really well?
Well said. For those that want to keep the conversation going, I'll be at the bar at the after party. Matt, Kara, Gerry, thank you so much for your time. You've all come a long way. Loved it. Thanks.
Great.